Hi everyone, welcome to ACCA P6 UK FA 2017. We are still at employment income. In the previous video we looked at the basic employment income, which is almost the same in F6 and P6. Now this is also part of employment income, but this is only relevant to ACCA advanced taxation, so it is not part of F6 and you haven't seen any of these in your earlier studies. The previous lecture, one of the previous lecture actually, I made exactly the same for F6 and P6 purposes because the benefits which we were looking at are exactly the same in F6 and P6 notes. Now one of the benefits, because there were lots of benefits, one of the benefit was that when I am using something given to me by my employer, now I'll have to take 20% of the market value of that as far as usage is concerned. However, if I'm going to buy that asset, then I'll have to see that how much does it cost at that time when I'm buying, and I'll have to deduct what I'm paying. That was one of the method. Of course there was other method as well in which we will deduct the already taxed amount as well. So say for example, if I'm going to buy this iPad, I will have to go to market, whatever the price of this iPad is and how much I actually paid, whatever the difference is, that is my benefit, because that is the discount which I have got from my boss, from my employer, and which will be considered as benefit. Right now, this thing which I have listed on the board, these are basically this chapter is relevant to the shares only. So when you are working for a company and you are the employer is giving you some shares in that company, so you will have to calculate the benefit. Now benefit will only be considered when your boss is going to give you the shares less than market value. So of course it will be benefit. However, if your boss is giving you the shares at the market price, then this is not considered as benefit because he is giving to the other people as well. So what is benefit? Benefit is simply when you are getting less than market value. Alright, now I've listed on the board on very left side here shares. So whenever you have got any share from your company, so we will take the market value of that and we will deduct the price actually paid by the employee. So whatever the difference is, that is a benefit as far as shares are concerned. So we'll take the market value when the shares are provided to you, less whatever you have actually paid for that. That will be our shares, benefit of the shares. Now sometimes shares are not given straight away, however you are given options. Options means that you are buying options, you are paying nominal amounts, say for example £5 to buy 1,000 options in the future. Options mean that you have an option but not the obligation to buy the shares in a future date at the price which is set now. So if I am buying options in whatever company which I am working for, I am giving some amount for the options. Now I have a contract that I have a choice to buy the shares in that company in the future, but the price is set now. So I'm getting the benefit because I have a choice. I might buy them shares, I may not buy, and price is already set. So of course the chances are the price will be higher than this price in the future, which when the execution date will come, when the exercise date will come. Now there are two dates relevant here. One is a grant date, when the options are granted to you. So when the boss says you have an option and they will give you a piece of paper which will say it is option. Now that is grant date, when your options are given. Another date is exercise date, when you will actually exercise your options. You will actually buy the shares. Alright, so that is exercise date. One is a grant date when the options are granted, and another one is exercise date when you actually buy the shares, when you actually buy it. Right? Now when the options are given, so as I said, there will be two stances. One would be a grant date, and there won't be any tax at all on the grant. So when the options are granted to you by your company, by your employer, then they will give you the option. Of course you will be paying something, but there won't be any benefit for tax purposes. So you do not have to calculate any taxable benefit. However, when the exercise date comes, you will have to calculate the tax benefit for the shares. So market value at exercise date, when you're going to buy the shares, whatever the market value at that date is, less amount paid for the shares, how much I'm actually paying for the shares, and price paid for the options as well. So options are not free, of course you have to pay for the options as well. So price paid for options by employee will also be deducted. Alright, so we'll take market value at exercise date, less amount paid for the shares, and less price paid for options by the employee. So if we deduct a couple of these things out of that will be the benefit on the exercise date as far as shares are concerned. Right? So there will be two dates, one is a grant date and another one is an exercise date. Now apart from these were basically simple calculations when the shares are given or the options are given. Apart from these, there are some schemes as far as our P6 advanced taxation is concerned. Now these are 4 schemes which I've listed on the board as well, and you can see in the chapter number 5 of your P6 notes. Now why I have noted down everything here on the board, just for yourself. So please make sure you write down whatever I am writing down on the board. Please make sure you note down on your notebooks. It will help you while you are doing the revision. Right? So these are basically schemes. On top it says that employee shares and option scheme. So these are given to the employees, and these are the the shares and the option scheme. 3 of them are basically the option scheme. So save as you earn, sometimes known as SAYE, S-A-Y-E, save as you earn. It's an option scheme. And then the company share option plan, like the name says option, so it is option scheme. Then the enterprise management incentive, or EMI, it is also an option scheme, so it is EMI. It is also an option scheme. And the share incentive plan, now it is not options, it is share scheme. Only this share incentive plan is the share scheme. Apart from that, all of them are option scheme, which means that the company will be giving the options to the employees, right? So there will be some benefits, taxable benefits. So that's why we are studying this. Otherwise there is no need to study. So we are only studying these schemes because these are beneficial for the employee for tax purposes, right? And all of these, in all of these cases, in all of the 4 schemes cases, whenever the company is setting up this scheme, of course they will be incurring some charges, they will be incurring some cost. That cost is deductible for company purposes, for in the company accounts. Alright, so that cost will be deducted. Right, so first one, save as you earn. Now you might not be able to read it clearly. I will read out to you, then you can write it down on your notebooks. However, if you are able to read my writing, then fair enough, just write it down please. Right, then save as you earn. First of all, SAYE scheme. So in this scheme what happens is that employee out of the salary will be contributing towards this scheme. So they will be saving some amount in the save as you earn scheme, right? So if I am working for a company, they will be paying me a salary. Out of that salary, some amount monthly I will be contributing in my SAYE scheme. I'll speak to my boss, I'll say I want to be part of this scheme. He said, alright, okay, you will have to contribute something every month. I said, okay, yeah, no problem at all. So I will be contributing something every month in that scheme. Now whatever the duration of this scheme is, there will be certain duration. After that duration, I have an option. I can either buy the shares in that company, or I can just withdraw the money. That is very, very good scheme. So I will be paying something in that scheme, and after the duration is ended of that scheme, I can withdraw the money, or if I want, I can buy shares in that company. Right, so I can pay monthly from £5 to £500. So minimum is £5 monthly and maximum is £500. And initially the duration will be 3 years. So initial duration of this SAYE scheme will be 3 years. After the 3 years are done, the company will give some bonus as well, right? So say for example, if you have contributed £200 in that scheme, after 3 years it won't be £200. The company will also be giving some bonus. The company will also be contributing some amount. So even if you want to withdraw after 3 years, you want to receive just £200 which you have invested, you will be receiving more than that. Well, I am talking about £200 per month, but of course it's after 3 years it's going to be huge amount. Say for example it was £6,000. So you want to receive £6,000 after 3 years, you will receive more than that because the company has put some bonus into it as well. Alright, now after 3 years, if you want, you can extend this scheme or you can just withdraw the money. Now if you want to extend the scheme, you can extend the scheme for further 2 years, so it will be 5 years. And if you reinvest for further 2 years, then company will pay another bonus as well. Company will put another money for another 2 years, so you will receive more money after 5 years. Right, so duration initially 3 years, but can be extended to 5 years. Now tax-free bonus after 3 and 5 years will be paid by employer. They will also pay after 3 years. However, if you thought that I want to invest for further 2 years as well, they will give another two years worth of bonus as well. So tax-free bonus after 3 years and 5 years by employer. A share price is fixed on options grant date. Now, whatever the grant date is, as I said, there will be 2 dates. One is the grant date when the options are granted, so the share price will be fixed at that date. Another one is exercise date. Now, in this, it says that share price is fixed on the options grant date, which must be at least 80% of the market value. All right, so it must be 80% of the market value. So whatever the market value is, it can be up to minimum of 80%. So you cannot give 30% discount, you can only give 20% discount to your employees. What people do is, what the companies does, on the grant date they will say whatever the market value is, I will obviously give you the discount, but they normally give the huge discount, sometimes half of the market price. So you can't do that in this scheme. Only it could be minimum of 80%. I mean the price of the shares will be minimum of 80% of the market value. Right, so share price is fixed on the options grant date, and it should be at least minimum of 80% of the market value. And only CGT will be payable when you eventually sell the shares. So if you sell the shares, then of course the capital gains tax will be payable. We haven't seen the capital gains tax yet, so whatever the market price is going to be, we'll deduct the cost out of it, and that's going to be our capital gains tax. There is a condition for this scheme, SAY scheme. Who can join this scheme? So must be open to all employees and full-time directors. So it is not all directors, it is full-time directors only. So it will be open to all employees and full-time directors. All right. Now in the question, I've seen in the past paper that there was a scenario, the huge scenario, and there was few things that the employees contributing £250, and the duration is for 3 years and stuff like that. And after that this scheme was open to all full-time employees and all directors, right? So that was the scenario of the question. So everything else was fine, just because in the question it said that it is open to all employees and all directors. It was not SAY scheme, because in the SAY scheme it must be open to all employees but only to full-time directors. All right, so in one of the past papers, I think it was in 2016, examiner has set up few conditions. All of the conditions are fine, but in this condition it said it is open to all employees and all directors. Right, so if examiner would have said all employees and full-time directors, then it would have been SAY scheme, but it wasn't SAY scheme. And some of the students, actually many students, wrote it as SAY scheme, and they omitted this very important condition. However, the minimum service criteria could be said. So although it is open to all employees and full-time directors, but minimum service criteria, so the people who have been in the company for 5 years, they can be part of this SAY scheme. Otherwise, if they have been less than 5 years, so they can't be part of this SAY scheme. However, it says that up to 5 years, so it could be 3 years, 2 years, maximum you can set it up to 5 years. So minimum service criteria could be set up to 5 years. right? Now, if you're still confused, it means that it will be open to only those employees who have been in the company for the specified time, right? So it could be up to 5 years, right? So that was our SAY scheme. Next one is a company share option plans. Excuse me. Now in this as well, company is giving the employees option to buy the shares. Company is giving a choice to the employees to buy the options in the company. Of course, they will be giving the options, and it is up to the employees if they want to exercise that option or not, right? So no income tax and national insurance contribution on grant, but it will be on the exercise. However, in the SAY scheme, there wasn't any income tax and NI, not even on the grant and not on the exercise as well. In this case as well, there won't be any income tax and NI on the grant. However, there could be tax. So there could be income tax and national insurance contribution on the exercise date. However, if you have fulfilled the condition, then you won't have to pay on exercise date as well. So what is the condition? That is a minimum holding condition on income tax, right? So if you have exercised the shares between 3 and 10 years, that's fine. However, if you have exercised less than 3 years or more than 10 years, then more than 10 years of the grant date, then you will have to pay income tax and national insurance contribution, right? There are certain conditions for this scheme to apply. So what is basically company share option plans? There are few conditions. First one, it says excuse me, price of share must not be less than the market value. In there it said 80% of the market value. However, it says exactly equal to the market value. It must not be less than market value at grant date. All right, so that is very, very important condition and very, very important difference between company share option plan and SAY. In SAY scheme, it is at least 80% of the market value. However, it is equal to the market value in company share option plans. Total market value of share option granted on employees must be less than £30,000. So total value of company share option plans must be less than £30,000. There wasn't any condition in this save as you earn scheme, but it is £30,000 in the company share option plans, right? And it need not to be open to all employees. It said that it must be open to all employees and full-time directors. However, it says need not be open to all employees. So you can specify that few people are eligible for this, and eligibility criteria may be set, and minimum service up to 18 months. You can also set this criteria of minimum service of up to 18 months, which was up to 5 years in the SAY scheme, right? So that is our save as you earn scheme. And after that, it says last one, if a closed company, then 30% shareholder must be excluded. Now closed companies, we haven't seen closed company for now, but just assume that closed company is a company which is owned by fewer shareholders, 5 or fewer shareholders. It is a closed company. So if it is a closed company, only 5 or fewer shareholders own that company, then the one who is owning 30% or more than that, then that shareholder must be excluded. Now, which company is a closed company? The company which the company share option plans is giving. All right, so that company in which the employee is working, in which he is intended to buy the shares. If that company is closed company, then the shareholder who is who owns 30% or more than that, that will be excluded to give these options. Right, so that was our company share option plans. Enterprise management incentive is another one. Now, like it says management, it is given to the it is given to the people who have very set careers, who are at the high positions in the very established companies. Now, say for example, if someone who worked in Coca-Cola at a very high level management, and if you want to attract that person to your new company, he might be reluctant to join your company. So he will be risking his set career, because your new beverage company is not secure. It might fail, it might, you never know. So that person is risking his own career to come to your company. So you must attract him by giving huge salary, but also give some shares as well. So that's what it is about, enterprise management incentive. So it is especially for those management joints who are already set in their own jobs at good career positions, but they are coming to your company, so you must invite them with good offers. Now up to £250,000 worth of options per employee can be given. Total must be less than £3 million. So up to £250,000 worth of options per employee. So by the way, why we are giving it? Of course, when we are giving these options, we want to set some targets for our directors or management, managers who are at these positions. So when we are giving these options, worth, say for example, £250,000, of course I want them to achieve some target as well. So I can set a target for them to achieve in order to qualify for these shares. Then that target which I am specifying, that must be clear enough while I'm giving the options at the grant date, right? Anyway, no discount on grant is allowed, so it must be equal to the market value. And in order to save income tax and national insurance contribution, so you cannot give any discounts if you want to save excuse me, no discount if you want to save the income tax and national insurance contribution. Just give me 1 second. Right, so excuse me, so you must not give any discount if your employees want to save income tax and national insurance contribution. Also, exercise must be within 10 years of the grant date in order to save the income tax and national insurance contribution. Right, so let's say exercise must be done within the 10 years of the grant date, so there is a certain limit. Alright, now although the discount should not be given in order to save the income tax and national insurance contribution, if however the discount is given, then the income tax and national insurance will be payable on what price? We'll take the market value at grant date. That's what it says, market value at the grant date, and we'll have to deduct the exercise price, whatever we have paid on the exercise date. Right, and after that, it's a target could be met, as I explained you earlier as well, that in order for you to give these shares to your employees who are senior managers, then you must also want to set some target so that they can achieve these targets. Only then they will be eligible for these shares or the options, right? Of course, you want them to work hard because your company is a new company. So you want them to work very hard. Alright, that's why you will set some targets. So they will be performance related. More good you do, more shares you will get. Right, so after that, there are certain conditions for the company. It could be quoted or unquoted company, but there is a limit on the gross assets, which must be less than 30 million, and the employees as well must be 250 or less than that. 250 equivalent full-time employees. It means if they are part-time, then it must be double than that, because it is full-time employees, which means 37.5 hours per week is considered full-time in the UK. Right, so they must be equivalent, must be 250 employees. Right, and there is a condition for employee as well. Must work at least 25 hours per week for the company, and if it is 30% shareholder, then he must be excluded from this scheme. And after that, the last scheme is SIPS. It is the only scheme where the shares are provided. Now up to £3,600 worth of free shares are given, which means that there won't be any income tax and national insurance contribution. So that's what it says, up to £3,600 worth of shares with no income tax and national insurance contribution. The target may be set for the free shares of course, if you're giving free shares, you want to see them perform, right? So of course you will set some target as well. So target may be set for free shares. Now after them £3,600 worth of free shares, employees are given option to buy further shares if they want. Now them further shares are known as partnership shares. I have written it as the further shares here. So these further shares are known as partnership shares. If you want to write down partnership share here, you can write down. Alright, so these are known as partnership shares. So employees could buy further shares, and how much they can buy? It will be lower of 10% of salary and £1,800. So lower of these two. So if 10% of the salary is 2,000, then it will be restricted to 1,800. So it will be lower of 10% of salary and £1,800. So whichever is lower. So if the 10% of the salary is lower than £1,800, it will be restricted to that amount. Or if 1,800 is lower, then it will be restricted to £1,800. Right now, employee can give matching shares. So if employee has bought further shares, which are known as partnership shares. Now of course these partnership shares won't be free. Employee will be paying for that. Now the first shares worth £3,600 are free. Then they can buy further partnership shares, which won't be free. And if you buy partnership shares, then your boss will give you further matching shares. So matching shares means these are some type of rights shares if you have studied in F3 or P2 as well. Alright, now employer can give you matching shares, and it will be if you hold 2 shares already, they will give you 1 more share. Alright, so that is the maximum proportion allowed. Now the conditions, eligibility criteria must be similar for all of the employees, and must be held in the plan for 5 years. That is the minimum holding period. So the minimum holding period for share incentive plan is 5 years. Alright, so if you hold the shares for 5 years, then there won't be any tax. Then it says that dividends are tax free if you have reinvested them dividends to buy further 6 shares. So if you buy a share incentive plan with your dividend, and you then invest for further 5 years, then it will be tax free. And if kept for 5 years, then there won't be income tax and won't be any national insurance contribution, but also there won't be any capital gains tax as well if you immediately sold them shares. So you don't have to pay any capital gains tax either. Right? So these are basically share scheme, and some of them are option scheme which are given to employees. Please make sure you note down all of these, and these are very, very important. Mark it as very, very important in chapter number 5 as far as P6 exam is concerned. Very, very important. Now I just quickly want to wind up this lecture. Before I wind up, there is another small topic as well. Just give me 1 second. Let me just share the screen as well with you. Termination payments. If you move to page number 27 of your lecture notes, please. Topic name is termination payments. So when you leave your employment, your employer will give you some amount. They will give you some money. Now that money is known as termination payment. Some of them will be mentioned to you in the contract which you have signed while starting the employment, and some of them will not be mentioned in the contract. So there are three types of termination payments. When you are leaving the employment, there will be 3 types of termination payment. One is fully taxable, other one is fully exempt, and the third one is partially exempt and partially taxable. All right. Now, first of all, we will look at fully exempt termination payments. So what are exempt termination payments? First of all, payment on account of injury, disability, and accidental death. So if you have been working on your job and you have been injured, then if the employer pays you something, then that will be exempt. Lump sum payment from registered pension scheme. Please remember, from the registered pension scheme it is exempt. However, if it is unregistered pension scheme, then it will be taxable. Cost recovered by the employee. So when you have lost your office and you have sued your boss, whatever the legal cost is, if you have received that legal cost compensation, that will be exempt as well. Right, and then these are the only ones which are exempt. Now we will look at the ones which are fully taxable. Now fully taxable obviously means that ones which are, especially ones which are mentioned in your contract, so that them will be fully taxable, and there will be some more as well. So let's see which ones are these. So if you have received any terminal bonus, say for example if your company has told you that you may leave now, and but you are on the notice period, but you have to do some special assignment for the notice period. So if you have received any terminal bonus, that is known as basically terminal bonus. So you are on the notice period, and but you are doing some assignment for your company, so that they will pay you something in exchange, of course. So that is known as a terminal payment. Then the payment in lieu of notice, we have stated in the original contract. If it is only stated in the original contract for the extension of the notice period, it will only be payable then. And after that, a payment by one employer. So if your employer wants you to work somewhere else, if he has seconded you to some other place, then that will also be fully taxable, the payment which you are receiving on that. Payment from unregistered pension scheme, as I said earlier, if it is registered, it will be exempt. However, if it is unregistered, it's going to be fully taxable. Now the restrictive covenants, an employee accepting a limitation on his future conduct or activities in return for a payment, these are also fully taxable. Sometimes your job is of a kind which is so technical and so secret that your company does not want you to work somewhere else for a specific period of time. Say for example, if you work for a secret agency, for example, then your employer will not want you to work somewhere else for a specific period of time after you get retired, of course in exchange for payment. So if you retire, if you have been fired or retired, and after that your company will say that you will not work anywhere for 2 years, we will although pay you some money. So that is known as restrictive covenants. So that money will also be fully taxable. Right, so these are only ones which are fully taxable. Now these are the ones which are partially taxable, which means that up to £30,000, first £30,000 is exempt. Whatever is on excess of that, that will be fully taxable. Other payments on termination are partly exempt. The first 30,000 is exempt, excess is taxable. Now first one is ex gratia payments. Now ex gratia payments are that your employer does not owe you anything. He is not bound by law, and he's not bound by contract as well, but he's just giving out of goodwill, so that when you go out you will tell other people as well, that is a nice employer, right? So your employer is not bound, but he's just giving away. Then compensation for loss of office, if you have received any payment, that will also be partially exempt. Payment for unfair dismissal, that will also be partially exempt if it is concluded that dismissal was unfair. That will also be partially exempt. And then statutory redundancy pay will also be partially exempt. Any benefits if you have received, that will be calculated under the normal benefit rule. Right, then after that it says that employer must tell HMRC about the termination settlements in 6th of July following the tax year. Right, so if you are an employer, you must tell HMRC that these are the employees which have left, and I am going to give some the terminal payments. So whatever the tax on that is, HMRC will then collect, and they will have in their records as well. Right, so that's it for now, and I will see you in the next lecture, and we will continue with our income tax. Right, now if you want to note down whatever I have written on the board, although this same information is given to you in the lecture notes, but I want you to note down, please, because it will help you while revising. Right, so that's it for now, and I will see you in the next video lecture. Goodbye.